the month of June of 2022. Now, believe it or not, today is June the for some reason it keeps muting me. Okay, should be unmuted right now. Anyway, today is June the 30th, which represents the last day of the second quarter of 2022. And it means tomorrow we're halfway through the second half of the year, the beginning. So I would hope that we'll have some information relative to the second quarter of activity, GDP, et cetera. Perhaps by as early as July, there'll be some hypothetical.
Dennis, you keep going on mute. I'm not sure what.
Then you, okay, I'll just keep my finger on that. So anyway, so today we've got an interesting talk that I want to talk about will be inflation, what the implications are, what is it, and how do we measure it? And then we'll get into some of the economic factors we have as well. So we're ready to get started, Robert. So the first thing we're going to do, our agenda today will focus on the key economic indicators, the global economy, the domestic economy, mergers and acquisitions, and other significant economic news and what's ahead in 2022. And today, our featured subject will be the inflation outlook. So what I want to do is take you kind of on an interesting ride this morning on inflation. So a lot of it, all we hear about on the news is the word inflation and numbers being punted around a lot. So let me give you an idea. So what is inflation? So inflation really is, it's the measure of purchasing power. It's defined as the rate at which prices and product services change over a period of time, usually within a 12-month period of time. And when inflation rises, consumer spending declines because prices go up and then people can't afford to buy as much. So what causes inflation? Well, there's a lot of factors that cause inflation. There's natural and man-made disasters like wars or oil spills can also cause prices going up. We also see the increase example in raw materials or the lack thereof skyrocketing, such as wood and things of that nature. And the increased demand for products and services can also drive up products, as you've seen over the last several months. And of course, you have federal policies such as raising and lowering interest rates. And and the other thing that I'll talk about a little bit later is the implications with supply chain. So how do we calculate inflation? Well, it's kind of a moving average. The consumer price index is really the key indicator. And typically the organization will look at about 24,000 specific consumers and track this with a survey of what they're purchasing over a period of time. So some of the variables included in this so-called basket of products and services would be items such as food and beverages, gasoline, computers, prescription drugs, college tuition, education, housing such as rent, apparel, transportation, and a host of other items that are really looked at. Now, typically they'll take a look, let's say, for example, on January 1st of 2020, and then they'll look at it on December 31 of 2020, just to get an idea what transpired. And also they go back month for month. So for example, we're now completing the month of June. When we hear the information in July, it'll be for the last 12 months, going back what took place. And the formula again is just looking at the beginning of periods from that perspective. Now, one of the things I wanted to tell you before we get started a little bit further here, I was able to attend the Chapman College economic forecast program last week, which was pretty interesting. And it was on for about 2 hours plus. What I'd like to do is cover 8 points that were sort of stood out to me that are really important. So first of all, inflation is being pegged at 8% through 2022. That's what the average will be by the year end. Secondly, mortgage rates are pegged to increase to year end by 6.25%. That could be a little low, or they could be pretty accurate. Now, the current economic environment is pre-recession is worth more than we've seen in prior recessions. And so going back over the last periods of time, the biggest concern the economists have today is one, inflation is rising at 8% by year end. Supply chain issues still persist. And of course, we have the price of oil remains high and could increase going further in the year. The likelihood of a recession, it's a question about when, how deep, and how long. In the past, we've seen recessions take place over approximately 9 quarters. Economists today are forecasting that we should see recession beginning sometime in the middle of 2023. I've talked to 2 people on Wall Street that are in the economic environment. They think it could occur as early as the end of the year. A lot depends. And then interesting thing is the trade deficit continues to escalate. Last year, we were well over $1 trillion. We're headed in the same direction, which is not good for our economy. In California, Sid, who's a Floridian, former California guy, before COVID, we had 17.7 million people working in the state of California. And as of now, we're at 17.2. So we're still about 500,000 jobs behind where we were pre-pandemic. Now, 150 California CEOs were surveyed, different sizes of companies, et cetera, in California on a variety of things. But the one thing that cropped up was 40% of these individuals indicated they're considering and planning to move out of the state of California. Now, when is that going to happen? Will it happen? It remains to be seen. So for those of you that are familiar with California, Chevron announced yesterday that they're moving their corporate offices from San Ramon, California to Texas. I believe it's going to be to Houston. And they're going to be selling all the land in San Ramon. So that's a major impact because this company has been there since Columbus came to California. So that's another major player is moving out of California. The other thing is why? Well, the commentary was the following: affordability of housing, state taxes, and then labor relations and regulations. So all these are the drivers basically causing a lot of companies and businesses to leave the state of California. So what are some of the key drivers of inflation? You wonder, what are these elements that we're looking at? First of all, we have increased money supply. And increased money supply is really defined as the total amount of money in circulation, which includes, for example, cash and coins, balances, and bank accounts. So if the money supply increases faster than the rate of production, we're seeing a rise in inflation. An increase in the money supply is usually created by the Federal Reserve, which we now call the Open Market Operations Committee. Devaluation. So devaluation is the downward adjustment in a country's exchange rate, resulting in lower values for a country's currency. So our currency is still pretty strong, but you can tell now it's taking more money to buy the same type of products. So what happens though, the devaluation of the currency makes a country's export less expensive. And the duration depends on when supply and demand can more equalize over time. Rising wages. So rising wages is exactly what it sounds like. It's an increase. It's being paid to workers. So really, wages are really a cost of production. So however, you have a mixed on this because the impact can be gradual wage increases, such as Sid getting a 3% raise for the year, or you can see situations in the labor rates where instead of being an annual rate, an hourly rate for blue collar employees at $15, it goes up to $25, so it goes to 24. So you're seeing a substantial increase. And that creates another impact on the employers and the companies where they have to increase wages for employees. And sometimes it's very difficult to raise those prices because, again, people will stop buying your product. In Silicon Valley, wage growth continues all the time. People go from Facebook to LinkedIn to someplace else, and there's usually a fairly significant impact. And plus, raises are pretty good in the Bay Area. I mean, it is what it is. It's a great area to work, to have a career. Supply chain disruptions, which I mentioned earlier, and severe global shortages of drivers and other workers are making it difficult to expand capacity or fix other problems plaguing the supply chains. So this creates a shortage of products getting through that limit of competition, causing price increases. So Ed Snyder, who's on the call with us, lives in a castle in Palos Verdes Estates. So every morning when Ed gets up and he goes out to have his coffee, he gets to look at San Pedro and he gets to look at Long Beach, and he'll say, you know what? This is Normandy with all the ships offshore there that still have to be unloaded. And that's going to take time before that thing gets resolved. The other thing we have is oil production and prices. So crude oil is really a major economic input. So the rise in oil prices contributes to inflation, which measures the overall price increases across the economy. And we're seeing higher oil prices raising inflation indirectly because it has an impact on petrochemicals and everything else, such as plastics, etc. And that's the main cause. So for those of you that like to buy fruits and vegetables, if the trucks driving these things really are based on the fuel. And so the price, for example, of some of this stuff is up as much as 50 to 75% in the last 12 months. Ergo, the price of fruits and vegetables and everything else continues to escalate. And then we have what I've mentioned all along is the shortage in truck drivers. You know, transportation experts say that the truck drivers are really driving the goods. We need more. I've talked about this over time. About a year and a half ago, they identified that we need at least 1 million truck drivers. Now, for those that they have to hire that are in special areas, they have to go through a lot of certification, such as driving a petrochemical truck or a gasoline truck versus a truck going to Vaughn's. And then, of course, finally, we have government regulations, and that's where tariffs are imposed. And then the implications from that has an effect on goods being imported and exported. So those are some of the drivers. So, you know, what 3 types of inflation are there? And basically, we have one, for example, is called demand pull inflation. And that happens when an imbalance occurs between supply and demand. When demand for a product outpaces production capacity, it really causes a strain on resources. Thus, the results are an increase in prices. For example, aluminum, wood, semiconductor chips, etc. The demand increases because of lack of product. We also have what we call cost push inflation. That occurs when production cost increases. An example of this could be found in the energy sector. So when the supply of crude oil is disrupted, demand may be unchanged, but gasoline prices will raise to offset the supplies that have lessened. Good example is in Torrance, California. A lot of times they'll close a plant for retrofitting, or there's a minor fire, and the next thing you know, gasoline is up to 20 cents a gallon. So why does raising interest rates really curb inflation? Well, it's widely accepted that lower rates spur economic growth. And by their definition, lower interest rates mean that the costs associated with borrowing, example, interest or premium on investment, must be able to receive funds immediately, and is lower. So when consumers pay less, they also have more money to spend, and therefore they feel more compelled maybe to buy more expensive goods such as refrigerators or automobiles, etc. But when things start going the other way, they become a little bit hesitant where to spend their money. It's a similarity with factories and corporations. They'll back off in spending capital goods, such as machinery, equipment, etc., which affects everything across the board. And how is inflation controlled? Well, as you know, consumers aren't the only ones who borrow money. You have the banks that borrow money and interact with each other, where they charge each other anywhere from 2 to 3% for funds. So when that goes up, their cost of business goes up, and typically they pass that along to you and I as the consumer. So people wonder, is inflation good or bad? Well, people generally look at inflation as very negative, because when prices rise and things become expensive, you can't afford it. But inflation can also be viewed as a positive. So for example, borrowers benefit from inflation, especially if it's reflected in an increase in income. So for example, if you're working, you get a 10% raise, that's good for you. And if hopefully some of your costs remain the same, there's a benefit there. Individuals that receive Social Security. So for example, it's estimated right now that the Social Security will increase by between 8 to 9% next year for those that are on Social Security. So that's a good thing as that rate goes up, because many people have to live based on what they get from Social Security. Even though it's difficult, that will go up in 2023. And then of course, companies benefit from inflation. So if they raise prices to meet surging demand, some of the costs they've had for the products sitting on the shelves, they can get more margin out of those because they're still sitting there. And then finally, when the Federal Reserve raises interest rates, lenders will receive a premium on the loans that they've already made. So there's some other things that are out there that people wonder about. So for example, what is deflation? So it's really the opposite of inflation. What happens is the price of goods and services decline, usually due to changes in monetary policy. So they get more for their dollar. In other words, deflation usually signals a slowdown in the economy. Disinflation, well, not to be confused with deflation, it simply means that inflation is increasing at a slower rate than previously expected. You go back over the last couple of years, things went up maybe a quarter of a point, a little bit here and there. It was not really relevant in terms of what was going on. Today, it's a different story. Then we have stagflation, which is not very good. So this is really a toxic combination of high inflation, unemployment, and a little to do with no economic growth. I'll give you an example. We go back several months ago, we were talking about shipping containers, and I think the price at one time was $2,300 a unit, went up to $3,000. Well, as you recall, the president made a comment not too long ago, shipping containers now are around $33,000 per unit. So who's going to pay for the products inside the container that are landing in San Pedro, Long Beach, and the East Coast? We are. So that's an issue. So again, there's really three indexes that you look at. You have the consumer price index, which is really a weighted average of prices. It's the baskets of good that we look at to drive what takes place. And this is it's really looking at the cost of living. You have the wholesale price index, and this measures inflation, which measures and it tracks the change of products that are being developed. Before they hit the retail marketplace, those products will go up. Example, if you look at cotton and the cost of the price of cotton and cotton yarn, gray cotton goods, etc., if they go up for clothing, the price in clothing will go up before the products get to the marketplace. And then we have the producer price index. And what we mean by that is it's an index family that measures the average change in selling prices received by domestic producers and intermediate goods and services at a given time. So how fast do we see inflation moving? Well, you really have 4 or 5 elements. You have walking, running, galloping, and of course, hyper. And of course, one is called creeping. So what I wanted to do is just give you a quick thumbnail. So creeping inflation occurs when prices rise by 3% or less, according to the Federal Reserve, when prices increase 2% or less. So we've seen that during the pandemic and a little bit before pandemic, things rose a little bit here and there. Then we have what we call walking inflation. And that's a strong or destructive inflation between 3 and 10%. Now, as you know, we've been running at 7, 8, or 9% lately. So now it's walking. And there's a concern there. When it gets to galloping, we're over 10%. And there's absolute havoc. And money loses the value quickly that business employees can't keep up with the cost of prices. So there are those that believe 2 things. One, some people believe that inflation for the month of June is somewhere between 10.3 and 10.8% for inflation. And I hope they're wrong, but that's what some of the people are predicting when we look at the numbers in July. And finally, we have hyperinflation, and that is when prices really skyrocket, such as items going up 50% or more in a given point in time. You remember the problems we had with wood? Now we're looking at the shipping containers. We're looking at diesel fuel. Diesel fuel has been up as much as 50% in a short window. And if you go back 12 or 13 months, it's up 94%. Well, think about all those trucks on the freeway that are using diesel, bringing products to markets, to Home Depot, etc. The prices continue to escalate. So that kind of takes you through inflation. I hope that gives you some insight in terms of what some of the components are. So now what I'd like to do is talk about the key economic indicators. So we're going to cover the gross domestic product, inflation, unemployment at the federal level, the California level, and of course, the price per barrel of oil, which is West Texas Intermediate. So if we look at the global GDP, if you look at the stars, the asterisks, those are changes from the last time we met. So first of all, they're now projecting the global GDP to run around 2.9% this year and then drop down to 2.4 next year. In the United States now we're looking at 2% and dropping down to 1.7% growth. So we're seeing a slowdown across the board. And if you look at inflation, again, it was pegged around 8%, could be higher, could be lower. We're not sure. You know, the Federal Reserve is going to meet again in July and discuss what the next steps are with the economy and with interest rates. So we'll get a better handle on that. And inflation next year, look at that number, 6.5%. We're still not out of the woods. The unemployment picture is going to change because if we start moving toward a recession, it's going to have an impact on the labor market. So we're now looking at 4.5% nationally, and in California around 4%. And then next year we're looking at 4.4 in California, which means it's up. It's up right now, excuse me, it's 4.4 now, dropping down to 4.1. Now, one of my favorite areas is the price per barrel in the range. And we've seen the range 2 or 3 years ago is about $15 a barrel. And now we're looking at somewhere around 25. Well, over the last couple of weeks, the good news is we're staying around $110 a barrel. And that's pretty good. It's minimal changes. 2 or 3 weeks ago, it was up to 116. Now, some of the oil countries, and I'll talk about this a little later, have agreed to increase production capability starting in July. And hopefully that may have an impact on oil prices in the United States as well as around the world. Now let's take a look at the global economy. A lot of stuff is going on globally. So first of all, if you look at the Bank of Australia, they've instituted rate hikes that they went up by 25 basis points. Again, concerned about inflation. Their growth is still moving along. They still have full employment, and pandemic is somewhat behind them. Bank of England and the Bank of Brazil are doing the same thing. They're raising rates at different values between 25 and 50 basis points. The Chinese economy, which is one of the top 2 and 3 in the world, you've seen here that their sales were down 11% over year from last year, and output fell by 2.9%. Keep in mind the Chinese economy announced several years ago, they're moving away from a manufacturing-based economy more toward a service-based. But the fact is, we're seeing implications there. And so it could be where their economy is looking somewhere around 4.5 down to maybe 4.1 in GDP for this year. Again, there's issues with their own currencies. Dimmer global outlook, the World Bank basically has cut their 2020 forecast for 22, as I said earlier, 2.9%. It was much higher. And they're also seeing things moving even further down for 2023 and 2024. Again, that has an impact on worldwide recession. And again, like I said earlier, the Chinese economy is slowing down. At one point over a year ago, it was around 8.1%. In better times, it's been between 10 and 12%. That's based on the figures that the Chinese government provides outside of China. So, you got to take that with a grain of salt. And the European Central Bank, again, they're seeing increases as well across the board. Bank of Canada basically had a rate hike. They went up 50 basis points, and they're taking more forceful stand to tackle inflation. They've got some problems just like we do. Of course, the Bank of England unexpectedly raised interest rates, and they saw a contraction in their economic growth in the last quarter. So some concerns there. And if Dr. David Gauci's on the line, the Swiss franc dropped value, and they've raised their interest rates by 50 basis points. So we're seeing this taking places all over the country, all over the world. Now, the domestic economy, for those of you who remember, in the middle of last month, Jerome Powell indicated they had moved up the interest rate by 75 basis points. There are some economists that felt that we should have taken it by 1 point up. There are those who think we need to take aggressive action in July and raise those rates the same, either 75 or 1. Now, the concern they have is this: where do you cross the line when you keep raising rates to the point where companies are going to have to start laying people off or freezing hiring? So they're watching this very, very carefully. But in the meantime, inflation is serious, and they're going to have to take whatever action necessary to drive inflation down. And again, it's called reducing consumption. So if you look at the invasion, by the way, of Russia by invasion of Ukraine by Russia, has also had a tremendous impact on the world economies in terms of they're producing like 8 million barrels a day. You have the offshoots there. So there's a lot of issues in there that's affecting worldwide economies as well. You look at the housing industry, there's warnings of real slowdown. There's been a drop in the confidence level across the board, and I'll mention some things later on the displacements area. But the cost of building materials is up 19% year over year. And so we look, and then basically construction is also beginning to slow down. April, it rose about 0.2 of a point. We're looking at an overall about 1.74 trillion for the year, but it's beginning to slow down. It's slowing down a little bit in the residential area as well. Again, some of the things we're looking at, we've talked about this in new housing. Costs have gone up between $30,000 and $50,000, $60,000 on top of the existing costs it takes to build homes. And we're seeing some of that in San Diego. We have a fire station that was delayed 3 months of being completed because they're having problems getting materials to complete the construction projects. And again, economists are looking that they're talking about mid 2023 for a recession. And again, I think it's going to be earlier than that. That's just my gut feel. Unless there's some really positive indicators, I think we're going to see a recession occurring sooner than that. So what's happening with the supply chain? Well, given all the moving parts, but inflation is getting blasted. I mean, we're looking at 8.6 over last year. And so the real concern is how do we move products from all the harbors in the United States to where they have to go to final destinations? And that's still having a major impact. We're chipping away. We're down several days, from 14 or 15 down to maybe 8 or 9, but we have a long way to go. So looking ahead, let's talk a little bit about inflation. As I mentioned earlier, we're now at a 40-year high. You go back to 1981 when we were at these levels. It's recently accelerated 8.6% in May. There are those that believe that we'll see it somewhere in the 10% plus when we close out the month of June. So we'll see what happens. What's interesting is that the market has seen energy prices in general up 35% approximately, gasoline 49%, and then fuel oil 107%, which is just unbelievable. When we look at the trade exports, the good news is we saw an increase of $12 billion in the month of April, and it's up to about 171 billion. So the good news is we are moving product out of the United States. The trade deficit, as I mentioned earlier, it's still too high. In other words, we can't go out again $1 trillion. That deficit is just too high. It's killing us. And that debt is spread across many, many countries. Retail sales, inflation is impacting consumers, and we saw a decline in sales slightly. We were down about 0.3 of a point. Now, as we move into July and August, for those that have little people in your home, like Sid, you're going to have to wait and see what spending is going to be like for school supplies going forward to see what happens, and clothing and all the things that they need for kids, to see what that is. The predictions are it's going to be down substantially from last year. And again, that's just an immediate type of thing right now. So we'll see some of that spending in July and August before kids go back to school sometime in August or early September. Now let's take a look at the employment picture. Given what's going on, we still had a very strong month in May. We saw the creation of 390,000 jobs, and we still see unemployment remaining at 3.6%. That's as of May. Keep a look at, if you look at business and professional services, we've had about 15 months of growth, which is very good. Construction is improving. The other thing I want to look at is look at leisure and hospitality. That's the one that got wiped out during the COVID timeframe. So we saw an increase there of 84,000. The negative number here is in retail. You're seeing a lot of retail jobs going away because of the affordability situation. So that's a concern going forward. Now we take a look at the state of California. Remember, I told you we're still behind a lot of jobs. We had almost 43,000 jobs were created. Unemployment decreased to 4.3%. I said worst case scenario could go up to 4.4 by year end. Construction had a good month with 7,100 new jobs. And then we look at information, the technology, and leisure, of course. And again, we saw almost 10,000 jobs eliminated in the retail space. Now, when we look at, again, we look at inflation, as I said earlier, the Federal Reserve is going to have to take what I said earlier, harsh steps, aggressive steps going forward to put more elements in the toolbox. So that when things get to a real situation, they have some things to work with to either inject currency or to lower interest rates. So they're far from where they need to be. So we're going to see that. Well, the next meeting, I believe, Jim Carr, is sometime between the 14th, 15th, and 16th of July before they make a decision as to next steps. So we'll get that in about 3 weeks. Mortgage rates inched up again. They're right now running around, on average across the country, around 5.58%. That's up from 5.5% about 2 weeks ago. As I said earlier, the projections are around 6.25%. And when I get into the housing market, I'll talk a little bit more, but there's speculation, like in the LA Times today, et cetera, that the price of homes will start to decline to a degree, and there may be more inventory coming online. But right now, unlike in past years, we don't have a lot of inventory on the marketplace. So if you look at Orange County, where Kathy is, Kathy would say, I have a home for sale, and maybe I have 15 or 20 plus people bidding on that one particular home. Well, maybe what's going to happen is as rates continue to go up and people can't afford to get in, what you'll see happen is that there'll be fewer people bidding on that place. So instead of 10 or 12, maybe there's 3 or 4, but there'll still be a lot of activity going forward. The manufacturing index, which is great news, it's at 56 points this time. Again, anytime it's over 50 with good news. If you're below 50, you're either entering into or in a recession. So manufacturing is still very strong in the United States. That's great news. You look at factory orders, Good news again, it was up again last month by 0.2 of a point to $533 billion in the month of April. Again, it's still strong and moving. That's very helpful. Now we start getting into some interesting areas. So small business confidence level continues to decline. It dropped again. It's around 93 right now, and the target has got to be at 100. If Bruce is on with us, one of the concerns Bruce has and I have as well is companies, small and mid-sized companies, have what they call loan covenants, which are the requirements for raising capital to continue to fund or expand your business. So when those covenants change toward a negative, things happen. You lose how much capital you can obtain from your loan, from your vendor, etc. So what happens is companies will have to start looking at their fixed and variable costs. And variable costs really are people, entertainment, travel, etc. So that's what you're going to see happening. Now, there are those that I've talked to that do this type of work that Bruce and I have done that believe we're going to see a lot of smaller companies going into bankruptcy going forward this year. And we'll wait and see what happens. Consumer confidence, good news is here, we're at 106 right now. The great news is we're well over 100, which is very positive. I said earlier that crude oil prices, if you can believe this, from month to month, from April to May, late June, we only saw a 30 cents increase. So that's good news. Now in California, effectively tomorrow, there's a 3 cents increase for, quote, new taxes. And so we'll see what happens going forward. Now let's take a look at I want to take a look at the housing market. I know we've got some real estate folks on here. So as you know, new homes construction fell 14.4% last month, which is significant. It's the lowest in 13 months. And we had a lot of all cash buyers and investors are beginning to pull money out of the marketplace. And again, supply disruptions have hit construction industry pretty hard across the board. New home sales had a strong month, about 10.2% in May. You know, as we move into May, June, and July, August, before, you know, families want to make moves. But in Southern California, it was a different picture. In 3 markets, in LA County, Orange County, and San Diego County, we saw the value of the homes, the midpoints went down slightly. And we also saw sales of product down. Significant in San Diego, but modest in both LA and Orange County. So that could be a sign of the times going forward as we move through June and July. Existing home sales across the country fell by 3.4%. Again, its existing home sales are falling back to pre-pandemic levels. Now, keep in mind the affordability index. So if you look at when we went into December of last year, the indicator said that we probably, of all the sales that took place, about 30%, give or take, were people that were first-time buyers. Well, the first-time buyers now are having a real problem getting into the marketplace. So that's going to have an effect on people. So for example, let's say Sid wants to buy, he was looking to buy a place for $850, and now what he can afford, maybe it has to be around $600 or $650. So they may still be able to get into the market, but they're just going to have to change their expectations of what they can qualify for. And the bad news here is this: banks don't want to own your property. They don't want to see foreclosures, all right? However, if you're out there and you have a variable loan, there are rules about escalation in your interest rates and what you can afford to pay. So that's going to come into effect going down the road. We're going to see that happening as it happened in 2008. Productivity, as you know, that's only done quarterly. So maybe by the end of July, we'll have numbers on the second quarter. Now take a look, for example, now, if we look at the following company displacements. So what we saw happen here is Tesla, as you know, is announced they're laying off 10,000 people over the next 2 to 3 months. They laid off 300 yesterday, which is part of that. There's a company called Coinbase. They're an American cryptocurrency exchange platform. They laid off 1,100. Warner Brothers Discovery, which is a sales support group, 1,000. And then we had JP Morgan in their real estate and mortgage area, 1,000. So we saw that happening. So that's taking place. So let's take a look at the M&A space. Keep in mind that the rates are still pretty low right now. So you're going to see a lot of activity for the time being. So first of all, Broadcom, as you may recall, over the last 2 years, twice tried to buy Qualcomm in San Diego, and that was blocked by the federal government. So Broadcom moved from Asia into Orange County. And what they're going to do now, they're going to buy a company called VMware, which was originally owned by EMC that went public a few years ago for 61 billion. What they want to do is buy the company, and then Broadcom is going to change the name of the company to VMware and get rid of that name. So that's the plan, so they can make more acquisitions in the United States and hopefully won't have problems with the federal government. MaxLinear is buying Silicon Motion. It's basically a radio frequency analog mixing company for circuit bands, does connectivity and infrastructure. So that's a deal worth about about $3 billion. Then we have a company called Shopify. Many of you know, we buy a lot there. So the history is it's creating an end-to-end logistics platform to unlock faster and more fulfillment for merchants. So that's the deal on the table there. Then we look at Pfizer, which again is active. They've been active over the last 3 years. They're buying Bowhaven Pharmaceutical for 11.6 billion. This is something where there's a lot of information with drugs, primarily in the migraine area of drug technology. So that's kind of what they're doing. They're expanding their portfolio. Intercontinental Exchange is acquiring Black Knight for 13 billion. Black Knight basically provides software and data analytics for the real estate market and housing finance market. So the idea there is to increase automation and try to drive down the cost of obtaining a mortgage. Then we have Brookfield is acquiring Watermark. It's one of the largest alternate investment management companies. Just got larger. This is a Toronto-based company that's acquiring Watermark for $3.8 billion, which includes 25 properties. If you stayed at the Ritz-Carlton, that's part of the acquisition. Then we have Choice Hotels is buying Radisson Hotel Group for Americas for $675 million. The acquisition is really expanding their portfolio. So the Radisson will disappear and going forward. In the real estate market in the Bay Area, San Francisco-based ProGlobe is acquiring Indianapolis Duke Realty for $26 billion. And that it's going to include 153 million square feet across the country in 19 major locations. So this is a major acquisition in the real estate marketplace. Now we look at a company called Mondelez is buying Cliff Bar for $2.9 billion. Who is this company? Well, they're the company that has a snack bar business, and it's called Oreo. They make Oreos. So Mondelez International said they're going to buy the energy company. They want to expand the business and expand more in what people are looking at in the global snack bar business to raise that and drive more business. So it's expanding their portfolio. So right now, keep in mind that interest rates are low as of today. So companies can buy other companies, and the debt that they're going to incur is lower as it is right now. That's why you've seen a lot of activity. And as the rates continue to go up, companies such as IBM, et cetera, will have to look and determine whether or not they want to make the transaction, depending upon what interest costs would be in terms of having to use capital or raise capital. Other significant economic news. Well, we've talked about this before, but diesel fuel is up 75% since 2021. And you can see that reflection is when you go to the store and you buy products. OPEC Plus, which includes all these other companies involved in the production and distribution of oil, has agreed starting in July to increase production by 648,000 barrels a day. And hopefully we'll have a positive impact on that going forward. Tesla, you're familiar with what we talked about. They have 99,000 employees, if you can believe that. They're getting rid of over about 10%, 10,000 jobs are going away. And Musk has also put a freeze on hiring. They currently have 5,000 job openings. Those jobs are going to be on hold for the time being. Twitter was fined $150 million. Again, that's for a problem they've had with protecting data, privacy, et cetera, over a 6-year period of time. We have Burger King, Wendy's. I believe they make square hamburgers. I can't remember. I think that's the one that does. They put themselves up for sale. And what they're trying to do is find a partner to explore a merger and acquisition in that marketplace. You'll see more consolidation taking place in the fast food chains going forward. Now, Target, which is a major retailer, is cutting prices and canceling orders with vendors because they have too much excess inventory. And because of the pandemic, et cetera, their cash flow is impacted by too much inventory. So the idea, they want to drop things down by maybe 30 or 40% from where the levels were over the last 2 years. So that's going to take first. Now we have Kohl's. You remember Kohl's is in trouble. They were talking to, maybe still talking to JCPenney about a deal. However, Franchise Group is working with Oak Street Real Estate Capital to finance a deal to take over the company. You may know that they own something called the Vitamin Shop, Buddy's Home Furnishings, among other brands. So they're trying to get a deal done for Kohl's. Then we have Revlon. I mentioned bankruptcies. Well, Revlon, for those of you that buy all these products, they're going to file Chapter 11 probably this week or next week. And they've got a $3.3 billion debt structure that has to be taken care of. Then we have a company called Compass, which is cutting the workforce about 10%. Basically, they're involved in they want to improve cash flow. The real estate technology company said it's winding down the Modus Technologies Group, which is a title escrow company involved in the real estate market. This company started in 2020. So there you're seeing the impact taking place there. Now, after 27 years, for Dan Ruckman's benefit, Microsoft, as of June the 15th, will no longer support Internet Explorer. So for those that continue to use the product, they will support Edge going forward, which is a higher product-based product. But you'll see that's the end of Internet Explorer. Then Kellogg, the big company, has decided to break the company into 3 smaller companies, and they'll focus on distinct snacking, cereal, and then plant-based businesses. So that's going forward as we speak. They want to have that done hopefully by the end of the year. So that we've covered a lot of stuff today. What I'd like to do now is open it up for questions and answers.